Good morning, everybody. Thank you for taking a minute to join us today, or for some of you, good afternoon, for those of you that are on the East Coast. We wanted to take just a minute today and go through some of the proposals that have come out in the recent Biden tax plan. Some of you might see it called the American Families Plan. Every now and again, it gets called the Build Back Better Plan. The most important thing for you to understand is that everything we're going to discuss today is proposed. None of this is actual law at this point. But what we wanted to do was really take you through this set of proposals because we think it'll give you a really good idea of the direction that the current administration is going and who may be impacted by it. Certainly, once a final bill is passed and into law, we'll host another version like this and go through with you what the actual law is. But until then, we'll be talking today solely about proposals. So today I'm going to be joined by Katie Dow and Lavia Thomas, two of our other advisors. And then James Smith is going to be handling the Q&A for us today. James and Jake Taylor joined us about mid-year this year as two new advisors to the team. And then to round out the team, most of you have all met both Rachel and Bryn before, the two of the folks in our operations team.
Hey, Mike. It looks like it froze on that first slide. Do you want to stop share and reshare?
Sure. Sorry about that, group. It looks like some things froze in our sharing. We'll see if Zoom can catch up with us here. So James, you just keep me updated here on if folks are able to track with our slides as we progress. So a couple of things real quickly, housekeeping items. We want to make sure everybody can see this as full screen as possible. We're going to be sharing some charts and graphs with you in a minute. One of the things that you can do, you can see on your screen here, in order to make the webinar full screen, in the very upper right-hand corner of your screen, you should see a small icon. If you click on that icon, it's going to have a drop-down menu. And if in that drop-down menu you click on speaker, it will change you to a full screen view. And I think that'll be helpful for you as we get to some of the charts and graphs later. And then finally, we want to encourage you to ask questions. This is really all about you guys getting the knowledge and information that you want and need. So we've got you all muted so that we don't have any background noise. And we're going to encourage you to ask questions through the chat box like we've always done before. If you sort of bring your cursor over the bottom of your screen, you'll see this ribbon pop up with different actions. If you'll click on chat, okay, it will pull up on the right-hand side of the screen. It will pull up a chat box. You can type your question into that chat box and hit enter. You can either share it with everyone, or if you want to send it to someone privately, if you don't want others to see your question or maybe associate your name with it, if you send it to Aspen Capital Management, if you type Aspen Capital in and you send it to that address, it'll come directly to us. Either way, it doesn't matter, but feel free to ask questions, and we'll stop a couple of times along the way and make sure that we're keeping up with the questions that are coming through. So real quickly, the agenda for today, we wanted to break this down into 3 sections. The first, probably the one that's on most people's minds, we're going to go through the proposed income and capital gain changes. Then the second section, Katie will take you through the first section. Lavia will take you through the second section, which is some of the other significant changes to the tax code. And then I'll come back and wrap it up with just a few strategies and ideas we have on things you could do for future tax planning strategies. So again, just a reminder for you, everything that we're talking about today is proposed. None of this is law, but we wanted to just get the message out to you to make sure that you had all the information. But again, what we're talking about is proposals.
Okay, hi everyone, this is Katie Dow. It's really nice to be with you today. Again, we're presenting on the text released by the House Ways and Means Committee this past September. It's important to note that if this proposal passes, it would be the largest tax increase since 1968. So while significant, the changes won't affect everyone, and today we're going to focus on that. I'll be walking you through the ordinary tax rates changes as well as the capital gains tax rate changes. And we have a lot of data to get through, so let's go ahead and get started. One of the centerpieces of this bill is a return of the top ordinary income tax bracket, taking it from 37% back to 39.6%. Now, 39.6% had been the top rate from 2013 through 2017, but was reduced back to 37% when the enactment of the Tax Cuts and Job Acts happened back again in 2018. So I do have some good news. If your taxable income, and this is important, if your taxable income is less than $400,000 for singles and $450,000 for married filing jointly taxpayers, you won't see any changes to your ordinary income tax bracket. But unfortunately, for those of you who make $400,000 or $450,000 more a year for married filing joint taxpayers, you are going to see a considerable increase. So let's look at this chart. On the left-hand side, you'll see your tax rate and the taxable income. 10% to 35% tax brackets, or really 10% to 32% tax brackets, are completely unchanged. When you get to 35%, there are a couple changes we want to mention. So first of all, under the next column, you can see single and the current proposed or the current tax bracket. And next to that, you can see the proposed tax brackets. So we highlighted this yellow because there's a compression here in that 35% tax bracket. You can see that the tax income changes have compressed down. So before, singles could make up to $523,000. Now they're only up to $400,000, and married filing jointly is only up to $450,000. Then they're kicked to the next tax bracket, and this is a big change as well. We skip over the 37% tax bracket completely, and we go directly to the highest tax bracket, which is 39.6%. So again, a couple key takeaways for you to remember. This is not retroactive to 2021. This would take in effect, if passed, in the year 2022. So big takeaway there. Also, the largest compression of the 35% tax bracket reduces the range of income to remain in the 35% tax bracket. So that yellow piece that we just talked about. Additionally, another big takeaway, much lower income thresholds for the highest tax bracket in the 39.6%, which is this red box here, both in single and married filing jointly. And finally, there are a lot of benefits to being married. I can speak to that for sure. However, your taxes are not going to be one of those benefits anymore. Married taxpayers are impacted the most here. You can see their reduction is much greater. And they kind of click up into that highest tax bracket faster here in these proposed changes. So you can really see that the administration is going after high income earners. And that is a theme you'll see throughout these changes. And we'll stay constant to that theme as we go over your capital gains tax changes.
Hey, Katie, sorry to interrupt for a second. Can you stop sharing and reshare again?
Yep, I will be happy to do that. Can you see that, James? Capital gains tax changes?
It's loading now.
All right.
It's there.
Perfect. So moving on to capital gains tax changes. So same story here. If you make less than $400,000 in income for single or $450,000 for married filing jointly taxpayers, you are unaffected. So if we look again to this chart, the tax rate and taxable income 0% is unchanged. The first change is in this 15% tax bracket. And you can again see that yellow box, which is a compression of the tax income ranges. So before, for singles, it was going up to $445,000, now is only at $400,000. Married filing jointly was going up to $501,000. Now the max income for that tax bracket is $450,000. So you can see there's a significant compression there. Also, you might see this range 15% to 18.8%. Very notable here is if you're a single taxpayer earning more than $200,000 or a married taxpayer earning more than $250,000, there's a 3.8% Medicare tax. So instead of 15%, your all-in capital gains rate would be 18.8%. Then we do away with the 23.8% tax bracket and we jump right to the 28.8. Really, this is the 25% tax bracket, but because everybody qualifies for that 3.8% Medicare tax surcharge, it really all in is 28.8%. So pretty significant takeaways here as well. Again, the most significant, I would say, takeaway here is this is retroactive as of September 14th, 2021. So if you're thinking about how can I be selling some equities here by the end of the year, I need to sell a house. I'm sorry, that time has passed. This is retroactive for September 14th, 2021. So all capital gains rate tax increases will be enacted if this proposal is passed from that date on. Some other key takeaways, again, the same compression of that 15% tax bracket. There's an increase in the highest capital gains tax bracket from 20 to 25%. And with that Medicare tax, it's really all in 28.8%. And again, I'm sorry, married couples, you are gonna get hit the most here. If you, for example, are a married couple earning between $450,000 and $500,000, you'll see a 10% increase in your capital gains. 10%, 18.8% here to 28.8%. So be thinking about that as we move on. Okay, something else I just want to touch on briefly here is an emphasis on ultra high income earners and the wealthy taxpayers. So this is a dramatic change, but it won't impact many. But for those taxpayers, it will impact. We really did want to kind of go over it because it's so large. It's such a dramatic change. So this section of the bill would require individuals who have both high income, so are again in that highest tax bracket, and they have 10 million of retirement account assets. So you have to have both here. You can't have one or the other. You have to have both. And then there's a couple things that are going to be put into place if this bill does pass. So first of all, if you meet both of those criteria, you can no longer make IRA contributions. Now, this is not doesn't apply to employer-sponsored or SEP or simple IRAs, but traditional IRAs, you won't be able to make those contributions. Okay, not a huge deal, but this next one is a huge deal. A new RMD or required minimum distribution of 50% of combined retirement balances over 10 million would be in place for 2022. And here's the kicker. It does not matter your age. So normally a required minimum distribution, you get to wait until you're 72. Here, age does not matter. So if you meet both of those criteria, we want to talk to you. It doesn't apply to most, but the few that it does, it's major. Okay, lastly, I just want to spend a little bit of time on the new tax rates for irrevocable trusts. So again, I just really want to note here that this is only for irrevocable trusts. So 95% of the people that we work with and the trusts that we see every day are revocable. But there are some big changes for irrevocable trusts. The highest tax rate will now jump to 39.6%. So again, if you look at that chart, it was at 37%. It's going to jump to 39.6%. And if your trust has income over $100,000, you'll be subject to a 3% surtax. So your all-in tax would actually be 42.6% on your irrevocable trust. Ouch. This becomes really important when we're talking about having your IRA beneficiary an irrevocable trust. So in 2022, a new law was passed for inherited IRAs, requiring the beneficiary to have an IRA completely depleted within a 10-year timeline. If you were to have a large IRA and needed to draw it down to zero within those 10 years, then this could bump your income, your yearly income, above $100,000 a year, subjecting you to that 42.6% tax rate. So big major change here, but again, only for irrevocable trusts. Okay, I hope that was helpful. We're going to stop really quick. James, we'll go to you for any questions. Do we have any questions right now?
Great. Yeah, we've had a couple questions roll in. I think you might have touched a little bit on this back when you were referring to capital gains. But we had a question come in saying, should I be realizing capital gains by the end of the year? And is there any way to, get in before the retroactive date?
Yeah, great question. Again, unfortunately, if this proposal is passed, it will, for just capital gains, be retroactive for September 14th, 2021. So unfortunately, that ship has sailed. You can no longer do any tax loss harvesting or be selling some highly appreciated equities in order to get in on the lower capital gains rates. That will be retroactive, James.
Okay, great. The last question I want to touch on before we move on is, how do I know if my trust is revocable or irrevocable?
Yeah, so that's a good question too. Again, 95% of the trusts that we work with are revocable. So if you have like the James Smith Family Trust, most likely that's revocable. You can go to your trust paperwork and look at that trust paperwork, and the name irrevocable trust will sometimes be, or most of the time be, in the title, or at least that certification of trust documents that will note that it's an irrevocable trust.
Okay, great.
All right, I'm going to hand it over to Livia now. She's going to go over significant changes to some additional tax codes. Livia.
Thank you, Katie, and good afternoon, everyone. Thank you again for joining us on this call. A couple of things that I want to point out today is I'll go through an overview of the proposed changes to the tax code. We'll touch on the estate exemption changes and some changes to popular retirement savings strategies. We'll also highlight a few pieces of good news about what isn't included before we move on to strategies available to you as you prepare for these changes. Now, as you can see, there's a common theme through this proposed legislation, which is really the administration focusing on the wealthy, and the wealthy being quantified as families with assets of $12 million and above. So I want to make sure we caveat this, that very few families will be impacted by this lifetime estate exemption change. However, for those of you that will be impacted, we wanted to go over a couple of the changes. First and foremost, what this proposed legislation does is reduces the estate exemption by 50%. So said another way, families will lose about $6 million of the exemption that you currently have access to today. For simplicity on this presentation, I am going to focus on the details related to those who file, those married couples who file jointly. But if you are a single filer and want additional information, please do reach out to us. Up through December 31st of 2021, a family had $23.4 million of exemption that you could use to pass your assets onto heirs or to gift onto heirs without a penalty. Now that amount drops to $11.7 million. So if we focus on who's really affected by this, I first want to point out any families with assets in the 8 million or under range, you really have no immediate issues. The biggest impact to you is you essentially have a shorter runway. Instead of having to wait until you're at 23.4 million, you now have 11.7 million before you have an estate tax issue. If you are a family with 12 million to 25 million plus in assets, you have a pretty big decision to make. You've got to decide what you want to keep and what you want to give away, because anything that that falls outside of the new exemption will be subject to a 40% tax rate. Now, those of you that are somewhere in the middle have a bigger challenge. If you have assets in the $10 to $11 million range, you really have a tough decision to make. You get to take the full exemption today if you gift away all of your assets, but that creates a challenge because you won't have anything to live off of. But you also have to decide if you give a portion of that away, and if that exceeds what the new exemption will be, you are now subject any amount over that to a 40% estate tax. Now, I do want to highlight this is something that will go into effect January 1 of 2022, but some of you may remember that this is a provision that's actually scheduled to sunset anyways in 2025. So the point being, while this legislation does bring this up in the timeline, this is something that was going to go back to the original amount in 2025. The good news is, from a historical perspective, even if it drops based on the legislation passing down to that $5.85 million level, that is still significantly higher than what it has been historically. So I would advise any of you that are in the asset range of 10 million plus to give us a call at your convenience so we can discuss this item and talk about some of the advice and strategies you have to be able to utilize in order to mitigate some of that impact. A little bit of good news here for people with children. The proposed legislation will maintain the 2021 status through 2025 in terms of the increased amount of tax credit, with being $3,600 for children under 6 years old and $3,000 for all other children. Another item that this proposed legislation does is places a higher phase out permanently for these amounts, which is to say that the phase out actually begins at $150,000 if you're married, $75,000 if you're single, and it phases out up to $400,000 in 2023 if you're married, $200,000 if you're single. So essentially, this proposed legislation broadened the income brackets that have access to this increased child tax credit, and it puts it into existence permanently going forward. Additionally, there is a specified child rule in 2023, which states that if you are caring for a child or providing financial assistance and they are under the age of 18, but you are not the parents, you can also benefit from the child tax credit. Some big changes in this proposed legislation will affect some of the popular retirement account strategies. Now, I do want to emphasize the majority of the clients that work with Aspen Capital Management are not going to be impacted by this change. If you are, especially if you are retired and an income under $450,000, you can still do the Roth conversions. But what I do want to focus on are a couple of things that are going away. One of which is the backdoor Roth contributions. So for those of you familiar with this strategy, if you were contributing non-deductible dollars to your IRA and converting into your Roth account, that will go away by December 31st of 2021. For those of you who have benefited from this emerging employer benefit through large companies like Microsoft, Google, Dell, HP, Apple, to name a few, you will no longer have access to the mega backdoor Roth 401k contributions. So if you are planning to do any sort of backdoor Roth contributions or mega backdoor Roth 401k contributions, you will need to get those in and completed by December 31st of 2021. Additionally, for those of you who are high earners and have large account balances, high earners being over $450,000 income if you're married filing jointly, and over $400,000 in income if you are filing single, you will no longer be able to do Roth conversions after 2031. So said another way, you have 10 years to complete these conversions before they are no longer available to you. I do want to reiterate though, those with taxable income of under 450,000 for married filing jointly can continue to convert indefinitely. So the key here, as long as your taxable income is under 450,000 for married filing jointly or 400,000 for single filers, you can continue to convert indefinitely. There's some other unique tax implications as part of this proposed bill. I would recommend, if you have an S Corp or if you are trading any cryptocurrencies, foreign currencies, or commodities, please give us a call and we are happy to walk you through some of the additional nuances of these items along with the QBI deduction. So some good news about what isn't in the proposed legislation. They will not eliminate the step up in basis, which is good news to heirs and beneficiaries. There is no state and local tax repeal. We do expect some level of the state and local tax relief to be in the final bill. There's just not a lot of clarity on what that's actually going to look like. The other bit of good news is they will not set ordinary income and capital gains taxes to be equal. This is one of the concerns that the public had that really would have affected a large group of people. So this is not going to be the case, which is to say that asset location, something that we do here at Aspen Capital Management, is absolutely still relevant. And a little bit of perspective there, even with the proposed legislation, the ordinary top bracket or ordinary income top bracket of 42.6% is still much higher than the capital gains top bracket of 28.8% for those over 450,000 in income a year, and 31.8% for those with 5 million of income plus a year. So there's still a pretty big gap between ordinary income and capital gains rates, which is to say that asset location will continue to be relevant as you put assets that generate capital gains into your taxable accounts and assets that generate ordinary income into your tax deferred accounts. So, one quick highlight as well, the wealth tax that was going to be based on net worth rather than income is also not in the proposed legislation. That was something that Bernie Sanders and Elizabeth Warren had originally proposed. So with that, Mike, I will turn it over to you to share some of the available strategies that our clients have access to.
Great. Hey, before I jump in, let me just ask James. James, do we have any questions that have come through?
Yeah, we do. It seems like the general theme so far of this tax proposal is if you make less than $450,000, you're not impacted too much. But we had a question that said, can I still do a Roth contribution if I make less than $450,000? And I'll go ahead and answer that one. In regards to a Roth contribution, you can contribute to a Roth IRA if you make less than 450, but not all people who make less than 450. And what I mean by that is there's a lower cap than that. So if you make less than $208,000 for 2021, then yes, you can contribute to a Roth IRA. But if you make more than that, then you cannot.
And I guess the point there is we don't expect that to change going forward. There's nothing in the proposed legislation that would change the ability for people to participate in a Roth or an IRA, correct?
Yeah, that's exactly right.
Great. Any other questions?
No, that's the one.
Super. Well, let me just wrap up here real quickly. I wanted to discuss some of the tax planning strategies that we've thought through as a team. Of things that you might want to be thinking about here before year end. Again, this is a little hard because these are proposed changes, but a few things that we came up with. Again, we want to come back to, there are actually very few people that are impacted by these changes. And certainly most retired people will not be impacted by virtually any of these changes. The proposed changes primarily impact those with gross incomes above 450,000 filing jointly, or people that have a total net worth above $11 million. But a couple of things that people could think about doing before year end, certainly taking advantage of the backdoor Roth IRA contribution and then conversion. There are very few people that qualify for this. Chances are if you qualify, we're already doing those for you. But if you have any questions on that, please reach out to your advisor and we're happy to talk you through that. For those of you that work for companies that have the mega backdoor Roth, Lavia mentioned a number of those high-tech companies earlier. You're absolutely going to want to work on maximizing that benefit before the end of the year. And then finally, as Lavia pointed out, if your net worth is 10, 11, 12 million dollars, you're going to want to give us a call so that we can start thinking about updating your estate plan and just making sure that your estate plan is in order to deal with some of these changes. And then longer term, again, this really only impacts those that are earning $450,000 or more. But maximizing Roth conversions before the end of 2031. So using that next decade, if you are that high income earner and you want to look at Roth conversions, you're going to want to make sure and get that done over the next decade before the end of 2031. And again, that's really a conversation that you should be having with us if you have any questions on that. Finally, again, just a reminder that these are all proposed tax changes and they're all subject to change. We will be updating you as soon as this legislation actually passes. Quick reminder, if you have any questions, please put them in the chat bar at the bottom and we'll be happy to answer any questions you've got. While you're entering any last questions that you might have, I wanted to update you. We actually have 2 more webinars coming up this fall on November 4th. We're really excited. We're going to have a portfolio manager from Dimensional Fund Advisors who's part of the team managing the global real estate fund that all of our clients own. We're going to be doing a webinar with them really to be able to give clients a deeper look into that global real estate holding that they own and kind of allow you to peel back the onion and really get a deeper understanding of exactly what that fund owns and why it's had such good performance over the last 10 and 20 year period. And then on December 6th, we're going to have a webinar on cybersecurity. With some folks from the cybersecurity team at Charles Schwab. We're going to do a fireside chat with them. That's really going to be focused on you and on tips and tricks and ideas that they would have for you on how you on your end can maximize your own personal cybersecurity. So with that, let me turn to you, James. Any last questions that have come in?
Yeah, we've had a few questions come in and actually a couple on the same topic regarding, do we have any type of expectation on when this bill might pass?
Oh gosh, while Katie laughs, I guess I'll take this one, and I think the question, the answer to that is no, we don't. I mean, I'm following this really kind of daily in the press, and you certainly can see that there is a growing level of motivation, I would say, on the Democratic side of the aisle to get this passed and to get something done. But these things, the way these negotiations work, usually nothing happens until the, kind of the absolute 11th hour.
Yeah. Another question in regards to how could these tax changes and these proposals affect interest rates, inflation, in the stock market?
That's a great question. So James, can you just read that for me one more time?
Yeah. How could these changes affect interest rates in the stock market?
Well, I'm going to focus. I'm going to defer on the interest rate side, and I am going to focus on the stock market. The changes that we discussed today are really all personal changes, right? There are also some changes in this legislation that don't have anything to do with individuals, that do have to do with corporate taxes. And if you look at the tax change that happened under the Trump administration, where they reduced corporate taxes, anytime corporate taxes go down, right, that means that corporations are generating more profit. And if a company is more profitable, their valuation tends to go up, right? And that's certainly what we saw driving a lot of the stock market during the Trump administration. Certainly, if you raise corporate taxes and you drive corporate profits down, one would absolutely believe that that would have to be a headwind on valuations and on stock prices.
Another question that's a little bit more general is, will this change of any of what we've been doing or what we normally do?
So I'll take that. Lavia and Katie, feel free to chime in here. I would say on our side, as we mentioned, the administration's objective in this was to really go after high wage earners. And they have clearly done that in the proposal, right? If you look at this, as Katie went through the different tax tables, the different capital gain tables, if you're at a point in your life where you're earning or you're retired, but your earnings are not at a high income level, there are really almost no impacts to you in this plan. As far as the work that we do, it really doesn't change our work, right? We're constantly focused on, how can we maximize clients' after-tax rates of return? Lavia mentioned that some of these changes will make it even more important to utilize things like asset location in someone's portfolio. But frankly, those are things we've been doing for 20 years.
I would just add to that, Mike, that we'll be really proactive in working with our clients that are in that higher income level, and being strategic in ways of perhaps accelerating income or thinking about bonus and commission structures, also in really utilizing deferred compensation options through employers. So with those clients, we'll be talking even more to them about how we can be strategic in working with them on different tax strategies moving forward.
I think we're kind of wrapping up at the end. One last question is, will there be any new tax relief for caring for elderly parents?
Boy, I'm gonna bounce that around the table. Has anybody seen anything in any of the proposed legislation on this topic?
Yeah, so how I would answer this is, I would say there is no new tax relief for caring for elderly parents. That's nothing that's included in the proposal. So if they didn't qualify before, there's no changes there.
Anybody else have any other comments on that?
No, but I do see one quick thing, James, not to take your job from you, but Mike, when can we expect those estimates from DFA to come out for distributions this year?
Oh, okay. What Katie's referring to is every year in the fourth quarter, we get year-end estimates for both December dividends as well as any year-end capital gain distributions. And historically, we get those in the first week of November. There's no hard and fast rule that that's when we'll get them, but I would certainly expect that by about November 7th or 8th, we will have estimates of what those year-end capital gain and dividend distributions in December would be. So people that are doing some tax planning work at the end of the year, like Roth conversions, we always proactively reach out to you and your accountant on those. But if you have any questions on what you think those will be, I would say by about November 8th or 10th, reach out to us and we should be able to get you some good data on those.
Okay, last question just to wrap it up that just came in. What if someone's income is low and then they sell a stock for a large amount? Is that considered income or taxed at the long-term capital gain rate?
But I chuckle because my real response is ask your accountant. If your income is very low, part of that capital gain could be taxed as ordinary income. And this is where this is where the tax code and situation get really tricky. So the best I can tell you is what we tell everybody that is in that situation is, so for example, if you are very low income and you generate $100,000 in capital gains, right, from the sale of a highly appreciated security, that 100% in capital gains is not going to be taxed at zero. Some of that will be taxed as some ordinary income. This is where the tax code is really tricky, and really without tax software, either through your accountant or if you're doing it through yourself, running a pro forma return through Quicken, if that's what you're using, is really what you would need to use. Well, it looks like that's all the questions. Again, I want to just do a last reminder to you that we've got a couple of webinars still coming up this fall. We really hope you'll have an opportunity to join us for both of them. On behalf of the whole team, a big thank you to James and Jake for putting together most of the slides and the information that we've shared with you here today. If you have any questions, feel free to reach out to your advisor. That's what we're here for. If something comes to mind in the coming weeks or month, just reach out to us and let us know what questions you have. Otherwise, we'll look forward to seeing you on November 4th for our real estate webinar with the fund manager from Dimensional Fund Advisors. Thank you.